Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is the money conversation of the day. Talley Leger shows up with Wealth Consulting Group, and he's got a research note with 12 items.
Wow.
It's Bloomberg surveillance, Talley. We don't have time for 12 items. Of the 12 items that you mentioned, sentiment, policy, fundamentals, which is the one the gloom crew most gets wrong?
I think it's got to be earnings front and center. And I think they're probably more important here, Tom, than they have been, given what was a public data drought. And I have to say, technology is leading the charge here with the best revenue growth, some of the best margins in the market, and the best earnings growth. And that's why we're willing to pay a higher multiple for these companies.
Boy, we're paying a higher multiple for these companies, and that's got a lot of people concerned. Do you believe the underlying cash flow and earnings are there to support these valuations?
100%. And so I think investors' wildest hopes and dreams are well placed for those very reasons. It's all about the quality. And we've talked about this before, Tom. I don't think this is an environment where the Boutle Marcus Keene text is really going to help you. This is the Charles Kindleberger text that you've got to dust off.
Right? Explain who Charles Kindleberger is.
So the late famous economist who penned the book Manias, Panics, and Crashes. And I think that this, if we're right, is the mania development stage. That's the part of the framework.
Yeah, but the fear crew, Paul, in the research notes, structural fear, and that crew of legitimate people are worried about the back end of the Charles Kindleberger book.
Which I'm just Googling right now, like the rest of the audience out there.
Yeah.
Talk to us about those earnings. Again, what was your takeaway from this earnings cycle? We're just kind of finishing up here.
So, I mean, it depends on what provider you look at. We look at all of them. FactSet is probably top of mind, and
not here.
Not at Bloomberg, of course. I shouldn't say those things, but we also look at Bloomberg as well. We're loyal followers, and they're coming in better than expected. And I think that speaks to the analyst bar, which is still structurally too low. And so that's why I like to say it's really the fundamental tech dominance that is supporting this market here.
How about this Federal Reserve here? We had a Fed cutting interest rates in the September meeting, but then kind of interjected a little bit of uncertainty into December. Do you care about timing when these rates cuts, or are you happy just to say, I know my Fed is cutting rates, so that timing's not as important to me?
It's a good point. So I am more of a directional guy than a false precisionist. And so I think that's right to expect probably another cut this year. Of the 65% that are in that camp, I would be among them. And I think what's supporting another cut before we close 2025 is the notion that the labor market is weakening here. That's part of the margin story, guys, powering earnings. But also the bond market is telling us the message here, Fed, you got to cut.
How about, are there sectors here that screen well for you guys? Because a lot of stuff's expensive. A lot of stuff is lagged. You look at the 493 names in the S&P 500. There's a lot of laggards there.
Yeah. So generally, we have strategically been of the mind that we'd be shopping the sales in the pro-cyclical economy sensitive areas of the market. And that's the game plan. We're sticking to it. Tech is still at the top of our list, but we also like old economy industrials. Materials, I think, are showing some promise, probably more a 2026 story at this stage.
Talley Leger with us here, with Wealth Consulting Group, with just a brilliant note pushing back against the gloom crew. There's beginning a partition. I felt it this weekend, and some of it is the politics of New York City and, frankly, the nation. There's people in the stock market prospering and everyone else. Do you sense that dichotomy in your practice at Wealth Consulting Group?
Absolutely. So I think it's important, Tom, to your point, to parse through the consumer sentiment data. And once you do, that trend reveals itself. And it's really the asset owners, and those are the people we do business with, our clients, that have actually been benefiting from this powerful wealth effect and the surge in the stock market. And so I think the best strategy here is to participate in these markets, even at these levels. We're at the midpoint between our baseline and uber bullish case of 7,000. I don't think we're going to stay down here for that much longer. We're probably going to end the year on a high note.
Alternatives, alts, as the kids call them, hedge funds, private equity, private credit. Sweet. How do they fit in with your discussions with your clients?
So we do have a liquid alternative strategy that serves as a kind of non-correlated bucket to some of the traditional asset classes like stocks and bonds. And they've done their job very well this year. And they include things like Bitcoin and gold and listed infrastructure. We've got an absolute return tracker in there as well, and really powered through the break in the market back in April and have been holding their own. And I think it just generally tells the story that diversification is really the only free lunch, guys.
All right, Talley. So I guess the real question here is, anything keep you up at night, or is this just cranking along here?
Well, it was the government shutdown, but guys, I got to say, these Bloomberg appearances are the lucky charm for markets, because here it looks like we're staring at a reopening of the government, and I think we rally into year end.
They just told me I can't take off any more days to the end of the year. We just keep going up.
Yep.
We protect the copyright of all of our guests. Talley Leger, I can't say enough about his research note. Look for that from Wealth Consulting Group, where he is Chief Market Strategist. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
BlackRock, Amanda Lynam gets us started on a Monday in a really important week as well. I don't read your note. I did a word search, okay? Issuance, and all that. I mean, you're so experienced in this before BlackRock and at BlackRock. Are we going to get a tsunami of billions of dollars of debt being issued?
Good morning. Thank you for having me. I would say, Tom, it's a great question. It's kind of already in process. 2025 is on pace to set the most active year since the pandemic era boom of 2020, which was just off the charts, almost $2 trillion of U.S. IG issuance. I think what's more notable to us outside of the robust headline figure has been the sector composition. We've seen sectors that historically have contributed a lot of issuance, like healthcare, kind of pare back a bit, and tech has been off the charts in terms of generating a new record, and that's something that's been notable.
We don't talk about it, folks, but it's prodigious Villanova accounting abilities, Price Waterhouse, whatever. I don't know what vintage they were then. You know, it's like Ernst and Winnie. These old names.
That's how I go.
And then Goldman Sachs. And now at BlackRock, I mean, you're incredibly steeped in this. Can you, under Merton Modigliani, can big tech substitute equity issuance and equity excitement by putting out debt? How do you treat their debt?
So I think there are two things to consider. One is a lot of these companies are still in a net cash position, which is important. So they're adding debt to their capital structure, but their leverage is still incredibly low because they have all of this cash on their balance sheet. The question is why? That's left over from the pre-2017 era when cash was generated overseas and then it needed to be taxed to be repatriated back to the U.S.
Oh, God,
so
lost me.
There's still some cash over there is the point. The second point is that there's a bit of an upper bound to how big these capital structures can get. So in our note, which we outline, we estimate that if you look at just like the Mag 7 X Tesla, so removing autos, there's probably an incremental 400 billion plus of incremental debt capacity if you just increase the gross leverage by half a turn. Really modest. That's a really large number, but we don't expect that to be utilized because these capital structures, we think, cannot get that large, and also that debt capacity will just be used gradually over time for strategic opportunities.
This is what surveillance is about, folks. What you just heard there is a window into a 2 p.m. meeting at BlackRock with 14 animals in the room, and Amanda begins to discuss, and everybody takes notes. It's about their ability, and this is a Richard Berner word from Morgan Stanley years ago, it's the fact that they can leverage. That's on the income statement, they can leverage to greater profit,
There's
right?
plenty of balance sheet capacity, even in some cases within the construct of the current debt rating, which is at the very high end of investment grade, to add debt to the capital structure. Our view is that this reminds me actually a lot of when I covered pharma in 2009. There was a wave of M&A as pharma combined with biotech, and CFOs and treasurers made the conscious decision to take a couple of notches of a downgrade to their debt rating. They stayed comfortably within investment grade, but they added some debt to their capital structure. It reminds me very much of that, but what's happening in AI and tech is obviously on a much bigger scale.
Is your market comfortable with the amount of, or the use of proceeds here to fund AI? Because a lot of it's kind of, we're not really sure what all this
stuff is. Are you an equity guy?
Exactly.
Some proceeds?
I would say the short answer is yes. You can see that very much in the order books. They're well oversubscribed relative to the debt deals. The second point kind of goes back to the pharma biotech experience I was sharing. In some cases, this is a bet on the management team. In pharma, it's not unusual to have a 30 or 40-year bond that matures well after the patent expires. In some cases, companies are betting on drug discovery that hasn't materialized yet. So in many cases, it's a bet on the management team and the industry to figure it out. I think there's still a lot of open questions about who will benefit most, what's the ultimate spending, what's the timeline. But it's very clear that there's a shortage of computing power, and there's a lot of needs for this.
Absent the tech names, the tech sector, how's the credit quality just in the investment grade area these days?
Sure. So half of the IG market is triple B, right? So still really solid credit metrics. Actually, we were talking about kind of all of the news flow and what's changed over the past few months. One thing that stayed the same is actually moving selectively down in credit quality has been the right outcome. Double Bs, so the high end of high yield, have been outperforming the low end of investment grade.
Okay.
Part of that is driven by, we think we're past peak tariff uncertainty. We see scope for growth to reaccelerate. At the end of the day, this is just a growth-sensitive asset class. And we also are past the peak headwinds on rates. And so we're still pretty comfortable with that view.
All right, I want to go back to big tech. Okay, let's pick a small company like Microsoft. They have tons of ability to issue debt. You see no threat to their build of cash or the fortress balance sheet that they have.
So leaving single names aside, I think there are a couple of tailwinds at play. One is a bunch of these companies just want to get to a net cash neutral position versus their debt.
They're catching up with Apple.
That's been in place for a couple of years for some of these big names. And so I would say over time, we should expect those cash balances to decline slightly, but they'll still hold larger cash balances, I think, relative to most sectors. Just the cash generation warrants it. The second is that there is some scope probably for ratings to drift lower, but we're starting from an exceptionally high level, AA territory for most of these companies. And so really their cost of capital is not that much more onerous if they took a couple of notches downgrades. Again, I want to emphasize, we don't expect that capacity to be used in the near term, selectively and gradually for strategic opportunities.
For mere mortals out there who don't understand leverage and all the other fancy jargon you're giving us, is next year a year to clip coupons or for total return?
I think it's still to clip the coupons because spreads at high yield, for example, still really tight, below 300 basis points. So if we start 2026 anywhere in the vicinity where we are now, there's just not a lot of room for spreads to move materially lower. And we don't expect rates to move materially lower either. So it will be about a yield and income story for us.
Do the beasts like you at BlackRock, do you talk to the full faith and credit people, or do you just hate each other across the aisle?
No, of course. I think the information flow in an environment like this that's so dynamic, I would add our equity colleagues to that. Foreign exchange,
we are the world.
I think I think sharing information is the way to actually have a competitive advantage.
She nailed that. I mean,
she knows what she's doing.
This is great. Amanda Lynam. That was an amazing brief, folks. Seriously, folks, an amazing brief there on the Mag 7 debt build out. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now, Liverpool correspondent Greg Boutle with BNP Paribas. Let's do this first. Are you kidding me? Man City's been flat out dead, and they whooped them 3-0 this weekend. What happened?
It was turbulence. We've seen some turbulence in the market, and I would consider this a pocket of turbulence and not something to read too much into.
What is it like being a Liverpool fan knowing that they like the Red Sox more or the Pittsburgh Penguins more than they like Liverpool? Do you feel like this American ownership is like too far away?
It is a little bit of an issue. Obviously, we get the World Cup here in next summer, so maybe that will help the Americanization of the game and increase the interest.
I only asked a question for 92.9 FM up in Boston. Good morning to Fenway Sports Group. Let's get to it. Greg Boutle with us with BNP Paribas with an absolutely spectacular note. And basically your note through all your derivative expertise says go long. Why?
Well, essentially what we've seen is this kind of pocket of turbulence the last couple of weeks. Government shutdown has been a part of it. Part of it, we think, is kind of positioning led, that the market got a bit of ahead of itself in September with this kind of real reach for upside, this exuberant rally. But what we've seen over the last, say, 3 or 4 weeks is a pullback in equities, a pickup in volatility at a time when the news flow that we have had, the bottom-up news flow, has actually been very strong.
Earnings, we just been through kind of the vast majority of earnings. Were they good enough for this market? Were they good enough for you and your call on this market?
Yeah, I think they were a really good earnings season. I mean, you can start with the large cap tech. And I think one of the best ways to look at the lens of earnings and distill the information is what did all the analysts do that cover the stocks with next year's numbers? And they took all of those numbers higher. So they digested that news from the calls, from the releases, and they increased their forecast.
Is it too early to do Jargon Alert?
No.
Jargon Alert with Greg Boutle, BNP Paribas. What in God's name is cleaner positioning?
Cleaner positioning. So we track equity positioning, the different various buyers and sellers, and some of those are pretty predictable, particularly some of the systematic strategies. So you have things like CTAs, essentially trend-following systematics. You have things like volatility target portfolios. They target the volatility of a portfolio. And these flows are quite predictable. And what we saw three weeks or so ago is that they were as extended as they have been, as long US equities as they have been in the last 5 years. So it wasn't necessarily surprising that we saw some selling flows from that pocket of the market when the market corrected. Overall, we're in neutral territory. So our positioning indicator peaked at 83 3 weeks ago. That was a year-to-date high. It's come back just below 50. That's neutral territory.
How do you measure short squeeze when there's so much gloom out there? Oops, we're going the wrong way. They repair the trades and up we go with convexity.
Yeah.
Can you measure a short squeeze at BNP Paribas?
Yeah, so we have a particular strand of our indicator that is directed to do specifically that. It looks at both the absolute level of short interest in stocks, but it also looks at the relative performance of the most shorted stocks. And what we saw was that those names massively performed in that squeeze in September. And there's been a really, what I consider, again, healthy correction in those names the last couple of weeks.
Arguably a valuable concern about this market is the concentration risk. And we've been talking about it for 2 years, I would say, maybe even longer. It doesn't seem to necessarily be a problem per se at the index level, but how do you guys think about that? Do you try to hedge it a little bit? Do you just let it ride?
I think fundamentally we could be in a cycle where we're forced to take concentration risk. If you had avoided those relative winners in the early parts of the cycle, it would have been obviously very problematic. So as this kind of structural bull story around AI continues, there's undoubtedly going to be concentration within that industry, and that's invariably going to translate into the market. So I think it's something that we have to learn to live with rather than avoid.
Other than those big tech names that, again, have performed so well, are there other sectors that you guys like at this time? Or is there a factor out there that screams well for you guys?
There's two things that we would look at. One is probably a little bit more medium term, and that's looking at the industrials. We think we saw some pretty good earnings from the cyclical sectors this past Q3. We think there is a CapEx story as we go into next year. If you want something more tactical over the next 6 weeks, we think the retail sector is one that's interesting to look at. There's a lot of headwinds for retail. There's concerns over the K-shaped economy and what's going on with the consumer, but it's a sector that's underperformed a lot, has been quite bombed out, and has a lot of catalysts coming up over the next 6 weeks.
Greg Boutle with us, head of U.S. equity and derivative strategy. We continue. He's at BNP Paribas this morning. Good morning across the nation, the way you listen to us to get your day, your week started. Good morning on Sirius XM, channel 121, and a particular good morning to YouTube. Paul and I blown away, the whole team just blown away by the commitment to YouTube listeners and viewers. It's subscribed to Bloomberg podcasts. It's the best way to do that. Paul,
there you go.
NASDAQ down 6.37% is the drawdown from the peak the day before Halloween. And we've bounced back this morning. We're up 3.27%. We haven't made it halfway back, but we're getting there.
We're getting there. Derivative strategy. What's the conversation you're having with your clients these days about derivatives? Are they to accentuate risk in the market, to hedge out the risk? Or how aggressive or are they using derivatives?
I mean, people are using them for both of those things. I mean, certainly one of the things which raised a warning flag to us towards the end of September was the fact that we saw this big reach for upside, i.e. people buying call options as a way to kind of extenuate risks, take more risk. So you certainly saw that in large cap tech where things became very extreme. If you look at a chart of just the trading volumes of call options in the US, it exploded going into that short-term market peak. So that was a sign of a little bit too much froth and exuberance.
And how is it different these days, if at all?
So, I mean, the thing which is different is there is a broader range of users. There's more use of derivative products. There are more expiries, more shorter dated options. So there's a ton of volume and risk taken. So it's incredibly important to track that to understand the market.
The people listening to this, particularly people with gray hair, are like, okay, 1987, we didn't see this coming. 1998, we didn't see this coming. What's the we didn't see this coming right now? What's the Greg Boutle phantom shadowy thing out there? Is it private credit? What is it?
Yeah, I think ultimately we don't know, but I think the obvious elephant in the room is large cap tech and these huge capex numbers. So I think the question that we try and ask a little bit more is, where are we in that cycle and what are the right ways to try and protect us?
Because Amanda Lynam at BlackRock was appallingly optimistic. Yeah. Do you feel like the solid and the bond issuance and the equity performance is normative?
I think it points, the bond issuance points to us moving to the next stage of that cycle. But to me, if I had to look back in history and look anywhere, I see some similarities to 1998, where we got a series of Fed rate cuts when earnings growth was pretty strong. We didn't necessarily need it. And that drove an incredibly volatile right move higher.
How far out are we? What was it, Paul? Help me. March of 2001?
Oh, yeah.
Was that when we went off a cliff?
March of 2000.
March of 2000, excuse me. How close are you, a wise one, to a March of 2000? Like doing a Liverpool.
So when we look at the risks at the moment, we think the largest risk at the moment is being underinvested if we do have those kind of bubble type tendencies start to emerge. The lessons from the late 90s is that if you were right and you felt there was too much exuberance and there was a crash coming, but you were too early in calling that was actually worse than not realizing we were in a bubble.
Greg Boutle, thank you so much for BNP Paribas. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Maybe she has some diversions, some distractions for us. Lisa Mateo in the newspapers.
I try my very best. Okay. We want to talk about the Disney blackout on YouTube TV because, yes, Monday Night Football has been affected. Dancing with the Stars. People want to see these things, okay? And they can on YouTube TV now because of this. So what they're doing is they're coming up with these clever hacks so that they can still get to watch it. The Wall Street Journal has this breakdown. It says one guy, he used an unwound paperclip, stuck it in his TV's coaxial port to get a signal. Others are going to Target and Best Buy. They're going to purchase antennas. They're hooking them up. They're going old school. They really want to see this programming.
Call up Comcast or Charter and get a cable bill.
Okay, or you can do that. Yes, or you can do that. And then actually, Business Insider is saying that YouTube TV is offering customers a $20 refund, a credit that they're going to put to the next bill to kind of help out with all this going on.
Can I ask a dumb question? Paul, are we just back to where we were 30 years ago?
Well,
where we're paying for 200 channels, but we're only watching 3?
Exactly. And yet, this time, though, you can cancel very easily. You just look at your just look at your bill, look at your phone and actually see what I'm subscribing to and just hit disconnect.
Yeah, but it just goes to show like how frustrated people are. At
There's no sense of this thing ending, right?
I don't know. I mean, if you're YouTube, you're Google, you have no incentive. I mean, you got plenty of cash to wait this thing out.
True.
Okay. Next.
Okay. This one was in the Wall Street Journal. It says you could be seeing less Italian pasta on U.S. store shelves. I know. Hold on. Here we go. So Italy's biggest pasta exporters, they say import anti-dumping duties, they are totaling 107% on their pasta brands. So coming to the U.S. is going to be a little bit too expensive for them. So you might have to deal with, the American brands that you kind of see out there. They spoke to the CEO at La Molisana. His name is Giuseppe Giuseppe Ferro. Okay.
Oh, boy.
And he said he makes those dozens, pasta made from flour from the company's own mill. Like it's good quality pasta. And it could be missing out on it. Anti-dumping probes are actually into Italian pasta makers. It's actually not new. A lot of importers were flooding the U.S. with cheaper pasta, but the penalties were usually small. But now those penalties are higher. So getting them here is going to cost them a lot more money.
I see it firsthand in my own house with Joe's Deli in Spring Lake, New Jersey. I can't get the chickpeas. We had a chickpea problem there for a while.
No, because it's too expensive for them.
Yeah, but they're back. They're back. You fixed it, but it was touch and go there for a while.
Yeah, it gets expensive for them with all the tariffs.
Yep.
Okay, and this one is kind of a shift. Okay, so luxury has this new competition from affordable French brands. Okay, I hope I'm pronouncing this right. Cézanne. Okay, it's become the global go-to for these preppy, French girl style. They have higher prices than, let's say, like a Zara, but lower than those high-priced luxury brands. So they cater to customers who are willing to pay over $300 for a bag, or maybe $120 for jeans, instead of like $3,000 for a designer bag.
Accessible luxury.
Yes, accessible luxury. That's what it's about. Because they're just getting tired of spending all this money, like $10,000 on a Chanel bag, when they can get more for their money. I know. It's taken this long to get to that point. But there's other brands that are doing it. So there's Ami Paris, there's Pollen, there's Lulu de Sasson. I'm trying my very best.
Right,
I'm killing it. But yes, smart luxury. That's what they're getting to. Where they're paying for the quality clothes, not the fashion
Please,
market.
I got to go to the what is dumb luxury?
Dumb luxury is pay $10,000 for a bag.
Is that really? Okay, it's good to know. Smart luxury in that. Do you have one more quick 20 seconds?
I don't. That's it. I know.
That's it. That's too much.
I'm killing it.
But it gets the week started as well. Newspapers with Lisa Mateo. We thank her for that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.